They have gone up anywhere from 0.5% to 0.75% already in the last month and a half, and they are talking about the rates being above 4% very soon.
Money costs more. So for those who may not know, what are the qualifying factors for an individual? I want to get a mortgage. What are the 3 or 4 main things that the lender or the mortgage broker is going to be looking at me as a borrower? You're listening to Copeland Morgan Media, your source for investment property analysis, education, and advice. Find us online at copelandmorgan.com. Welcome back, and thank you for listening. I'm your host, Jeff Copeland, and with me in the Copeland Morgan studio today is Tracie Mayo, our resident mortgage expert. Tracie, you've technically been on the show before, but it was via Zoom, like a webinar type format. So this is your first time live in studio. It's great to see you face to face.
It is. I love seeing you face to face.
So we're going to just dive into residential mortgage stuff today. I don't have any pre-scripted agenda or anything like that, but for people who may not have seen you on the previous episodes or previous coaching sessions that we did last year, tell us a little bit about yourself. How did you end up in the mortgage business, and how's that going for you?
It's going well. I've been in the mortgage industry since 2013. I was with a federal agency, United States Postal Service, for about 21 years and got burned out. Needed something else to do. My spouse introduced me to
Some might say you went postal.
I did go postal, for sure. You have no idea. But my spouse introduced me to the mortgage industry, and it was the best thing that ever happened. We've just been going gangbusters since then.
And your company is called Savvy Mortgage, SAVVY. You're in downtown St Petersburg, Florida.
Yep.
SavvyMortgage.com, correct?
SavvyMortgage.com.
Awesome. And you do residential mortgages, correct? You don't really do non-traditional products, and you don't really do commercial. Is that a fair statement?
That's a pretty fair statement. We do occasionally do the non-traditional DSCR, non-QM types of transactions, but we do not do any commercial.
Okay. And so for somebody who's new to real estate investing, what are some of the differences from maybe buying your primary residence, and now you've saved up a down payment and you want to buy an investment property, and it's very, very similar process, but it's not exactly the same. And what would you say are some of the key differences in those two types of loan products?
The big differences are the amount of down payment that's required, and that also depends on whether it's single family or multi-unit, multifamily. So the down payment requirement is higher. The rates can be significantly higher depending on the type of transaction that we're doing. So those are probably the two big differences that I can think of. And
correct me if I'm wrong, but typically for an investment property, it's 25% down. That's generally the normal rate. You may get some fluctuations here and there.
Yeah, that's
correct. But typically lenders want to see 25% down on an investment property that you're not living in. And then a good rule of thumb typically is it's going to be about a point higher on the interest rate than what your primary residence is. Because I know sometimes people are surprised. Well, I got a 3.25 on my primary residence. Why is my investment property pre-approval for 4.5%?
Yeah.
That's just normal. It's a higher risk loan to the lenders, and so they're going to factor that into their rates.
Absolutely. And because it is a higher risk loan for the lender, they will also require reserves to be in place for each property that you have financed. They want to make sure that you've got the reserves in place to pay those bills when they come due.
Yeah, that's a great point, and it's something that I've dealt with. As you know, as a rule of thumb, how many months of reserves do you need to have if you own other investment properties to qualify for the next one? Yeah,
as a rule of thumb, I'm going to go on the high end because lenders do vary, but it's usually 6 months worth of reserves for each property that you have financed.
And is that just to cover the debt service, or is that debt service and operating expenses? I mean, they don't really know what your operating expenses are.
Yeah, it's just the debt service.
So mortgage payments. So if your mortgage payment's $1,000 a month for house one, you need to have $6,000 in reserves. And that can be cash or investment accounts or whatever, but you need to have a little buffer.
Exactly.
Is what the mortgage companies want to see. So that is a big difference from your primary residence. You need to have the down payment and the income and everything else, but they're not looking for extra.
Yeah, they're not. When you're buying your primary home, you could be living paycheck to paycheck, which is a little scary.
Many people do, though.
Yeah.
That's a fair point. And so one of the big questions, it's currently, February 2022, and all we hear is rates are going up, the Fed's going to raise rates. What does that mean when the Fed raises rates, and then how does that trickle down to the mortgage industry, and where do you see rates going over the next 12 months?
Well, I definitely see rates increasing for sure. And when the Feds start indicating that they are going to raise the rates, lenders start reacting, the market starts reacting, lenders start totally creeping up on those interest rates to kind of start that process. Because when the Feds say they're going to raise it, the prime rate is going to go up, and then that means the cost that the lenders have for those rates are going to increase.
And so how much of it have we already seen rates tick up, and how much more should we expect to see after the Fed makes that announcement?
Yeah, they have gone up anywhere from 0.5% to 0.75% already in the last month and a half, and they are talking about the rates being above 4% very soon.
And for those of you listening, what that really means for us as buyers and investors is money costs more. So if you can afford a mortgage payment of $1,000 a month, well, at 3% interest, that might buy you a $150,000 house. But at 4% interest, now you can only afford a $120,000 house. So it cools off the demand a little bit because money isn't as cheap as it used to be, and you can't afford as much as you used to. And so it may not be a terrible thing for the Tampa Bay real estate market, because we've seen these 20% year over year price increases that are pricing a lot of people out of the market. They're creating, supply shortages. And as the market, I think, starts to normalize a little bit and rates creep back up, the demand tamps down just a little bit, and maybe prices ease a little bit and don't keep going up so fast. So higher rates are not a terrible thing for real estate investors. Yeah, you're going to pay a little more for your interest rate. Your debt service is going to cost you a little more. You won't be able to afford quite as much, but it's offset by the fact that maybe the prices will ease a little bit.
Yeah, and I tend to believe that rates going up is not a bad thing. I mean, it really does need to. We've been at an all-time low over the last 2 years, and we really need it to kind of slow down the market just a little bit, in my opinion. So I agree. I think it's not a bad thing.
Cool. So for a new real estate investor sitting right now listening in Chicago or Boston or whatever, and they want to start investing in real estate, maybe it's their first investment property purchase, what are their options in terms of financing that property? What different types of loan products are out there that you may want to look at and consider to use for an investment property?
So we've got the traditional financing, which is conventional with the 25% down. There is the FHA option if they're going to be buying a multi-unit property and they are going to live in one unit as a primary. They can buy that multi-unit, 2, 3, 4 unit, and rent those other units out. And then there's also the debt service coverage ratio loan that does come with slightly higher interest rates, but it does, as long as you make a 1% profit, then you can get qualified without us looking at income. It's a really good option. And then there's, of course, the non-QM types of different other options. And it's a big term for a lot of different products that are out there.
What do you mean by QM for those listening?
Qualified mortgage. So a non-QM, a qualified mortgage is something that that the lender looks at, and it falls into standard guidelines, and it's you've got a debt to income ratio that you're staying under and all of that, and they're looking at income and liabilities. The non-QM is the non-traditional type of loan. It's not a qualified mortgage, but there are ways of qualifying you for it.
So that's a little bit more similar to a commercial loan. They're looking at the property. How much income does the property produce? How much expenses does the property have?
Yeah.
What's left over at the end? And we'll use that to qualify you for a mortgage, but maybe on a more residential type property and not a larger commercial property.
Exactly.
So for those who may not know, what are the qualifying factors for an individual? I want to get a mortgage. What are the 3 or 4 main things that the lender or the mortgage broker is going to be looking at me as a borrower?
So we're going to look at your credit scores. That's what most people know we're going to look at. And then we're going to look at your debt to income ratio. And depending on which option we go into, the debt to income ratio is different for the different loan programs. So we're going to look at how much you make versus how much you owe each month. We are going to look at loan to value, how much you're borrowing versus how much the property is actually valued at. And those are the big things that we're looking at. And then,
And income, of course.
debt to income. Yeah.
Right.
So, those are the big ones.
And this is something I'm curious about because I deal with this, and I know a lot of other real estate investors do. Our credit score and our DTI tends to fluctuate because right now I'm in the middle of renovating a property, so I've run up some debt. I'm spending more money. I'm not collecting rents yet. But when that property is stabilized and say I refinance it and I pay off some of my credit card debt and now my credit score shoots back up to kind of normal levels, how much of a seasoning do they want to see in your credit score? Or is it just a one-time pull and that's your score?
Well, I mean, pretty much actually, when we pull credit, that's what we're looking at. So, I mean, it's a moment in time. It's kind of like an old photo. You take a picture and that's what you get. And so when we pull that credit score, that's what it is. Now, if something happens and things do fluctuate and there's a few months that go by, we might want to pull credit again to see if we can now get a better score because that's going to dictate the rate.
Sure. And so a lot of people may not realize this, but there is a limit to the number of what they call conforming loans that an individual can have. And correct me if I'm wrong, but that's 10, right?
It is 10.
So for people who are getting a little more advanced in their real estate investing career and they're taking advantage of these historic, 3% interest rates and they've got 9, 10 loans and now they want to buy that 11th property. I'm assuming that's where some of these non-QM products come in. That's where maybe you can consider, a commercial product or something along those lines.
Yeah.
Do you have anything to add there in terms of getting to that 10 loan limit?
Yeah, you can definitely go the commercial route. You can also do a little house hacking, honestly. I mean, if we could do a cash out refinance on one of the other properties and get enough equity out of a property that you do maybe have some equity in, pay off one of the loans, and now you've only got 9 financed properties. So now you go and buy the 10th property with financing. So there's all kinds of house hacking that you can do in that regard. There's not a limit to the number of loans that you can have financed when you're buying a primary home. So it could be that, that next home, you just might have to live in it for a couple of years and make it your primary.
Yeah, that's a great point.
Yeah, so there are ways to get around that 10 loan, but definitely if you're maxed out and you have no other options, we go the commercial route.
What about husband and wife or a couple scenario? I see a lot of people keep the loans in their own name and not in joint names. Is that a valid strategy, like when you're married or when you're cohabitating with someone?
Yeah, it's definitely a strategy. And as long as you're not listed on the deed, then we don't have to hit you with any of that if you're not part of the transaction. So it's a really good way to have 10 or 20 loans between the two of you.
Sure.
Yeah.
So you mentioned the term house hack, and when you mentioned it, you were really talking about sort of a finance hack. Mm-hmm. We're gonna refinance property A, and we're gonna use that to pay off property B. Now that frees up one more loan that I can get. But when most people hear the term house hacking, what they're referring to, or what it's commonly thought of as, is buying a multifamily, often, hopefully, with as low a down payment as possible, and living in one unit and renting out the other 1, 2, or 3 units. Does that differ much from a financing perspective in terms of how you qualify and down payment requirements and things like that if you're going to buy a multifamily and live in one of the units?
Yeah, depending on which loan you go into. So if you go into an FHA loan and the house qualifies for FHA, you're going to get in with as little as 3.5% down, which is huge. And it's the way a lot of investors do start that house hacking. And then if you go conventional, a 2-unit usually requires about 15% down if you're going to be living in it as a primary. And then if you buy a 3 or 4 unit, you do have to put that 25% down.
So 3 and 4 units is where the sort of line in the sand is, and it just goes back up to the normal 25%. And that's even for FHA?
That is not for FHA.
Okay.
So FHA, you can get in with 3.5% down up to 4
Wow.
units.
Yeah, that's a very attractive option for a lot of people, especially just starting out. On the flip side of that, sitting on this side of the table, I have to tell people in a hot market like we've seen for the last few years, it is incredibly difficult to shop with FHA because FHA comes with more red tape, more appraisal hassles, more property condition hassles. Can you dive into what some of those are?
Yeah, the big issues with FHA are roof, rotted wood, peeling paint, HVAC. They want to make sure that all of those things are in good shape. And that's just an FHA requirement because they're trying to look out for the buyer. What I normally do is, for my referral partners, if they're trying to make an offer going FHA, I will actually reach out to the listing agent myself and have a conversation with the listing agent and say, hey, is there anything wrong with this house that we need to be concerned about? They have the ability to go conventional, but their best option is to go FHA. Would you consider an FHA offer on this? And if they say, look, the roof was just put on 2 years ago, the HVAC is fine, I'm going to say, do you have a problem with us doing this FHA? And if they say no, then we're going FHA, because that is normally the best option. But that's how I kind of try to get around that, because sellers are leery to take an FHA offer because, and I mean, for lack of a better term, I'm just going to say that it's ignorance to the loan and ignorance to what they're looking at, because if the house is in good shape, you're fine.
Yeah, you brought up a couple of outstanding points, especially if you're a real estate agent listening. There is nothing more valuable, there is nothing more powerful than having your mortgage person, your mortgage lender or mortgage broker cell phone number and saying, hey, can you talk to this listing agent? Mm-hmm. Can you talk to the seller?
Yeah.
And so that is huge, is making yourself available. So, if you're working with Quicken Loans or somebody where you can't get them on the phone yourself, let alone have the listing agent or the seller call them and vet your buyer, you might want to rethink your strategy in terms of financing. The other thing that you mentioned that I think is a really interesting point is telling them, hey, the buyer could go conventional if they want to. They're a well-qualified buyer. They do have the down payment. They just want to take advantage of the better rate and the better terms offered by this FHA loan product. Because a lot of times, if you're the listing agent and you get an FHA offer, 3.5% down, you just assume that the buyer has no money.
Exactly.
And they're going to put 3.5% down, and the appraisal is going to come in short, and they don't have any money to make up the difference, and it kills the deal, but you don't find out for 3 or 4 weeks when you get the appraisal back. That's what you're expecting. And to know, because I spoke to their mortgage person, they're well qualified. They got money in the bank. They can switch to conventional if they want to, and maybe an appraisal shortage is not going to be a big deal even with FHA. That's a huge difference from just getting a random FHA offer and making those assumptions, which do happen a lot.
Yeah.
But to know that the buyer has options and the buyer is well qualified and they're going FHA just out of convenience, not out of necessity, I think that is huge for a seller and a listing agent to really know those points.
Yeah, and that's why I say that, it's basic ignorance sometimes, because, again, the realtor does make assumptions about, and everybody makes an assumption about a buyer based on the loan program that they're putting in, that they only have the minimum to put down, and they don't. And it's the same thing, and this is not really what we're talking about in this particular podcast, but, it's the same thing with cash offers. People make cash offers, but they can still make the decision to go ahead and get financing. But they do have the ability to pay cash.
Right.
So
that's a good point. It's the ability to pay, or the ability to get the deal done, not necessarily the terms that you're proposing. But if you don't communicate that to them as the buyer's agent, there's no way they're going to know. Mm-mm. Is this just a poor person who only has 3.5% and they're just desperate to get into this duplex, or is this a savvy investor who's taken advantage of the rates and terms of FHA, but they can switch to conventional in a heartbeat if they need to?
If they have
That's
to.
a huge difference. And agents sometimes have a real bad habit of just attaching the PDF offer and sending it, saying, see attached.
Yeah.
You need to explain, you need to give a little intro in your email, sort of a cover letter, like, here's what we're doing, here's the strategy, here's who the buyer is, here's who the lender is, and here's what I'm presenting to you.
Yep.
And it's all negotiable. And if you don't give that little intro, sometimes they're just going to assume the worst. And if it says FHA 3.5% down, they're going to put it aside and move on to the offers that look better on paper.
Yep.
Another question I get all the time is, I have a conventional loan and I want to put the property in the name of my LLC. For whatever reason, they think it's for liability protection, which may or may not be a savvy move. But what is your take on that as a lender? Up front, you generally cannot put the property in the name of an LLC if you're using conventional financing. The two don't go hand in hand. Is that correct?
That is correct. Yeah, if it goes into the name of an LLC, it's considered commercial as far as lenders are concerned. As far as after financing, I know plenty of investors that do move their properties out of their personal name into an LLC, and I've never seen any issue with it whatsoever. And I have actually reached out to our account executives with the different lenders that we work with, and I've specifically asked the question, is this going to be an issue if they do this? And they all say no.
I've never seen it personally happen, but I have heard of people having their due on sale clause because they transferred title to the property, which they had pledged as collateral.
Yep.
And so technically that means, hey, pay us up. You don't even own the property anymore, so how can it be collateral for your loan? But I think where people can possibly go wrong, and this has nothing to do with the mortgage side of things, is insurance. So if Jeff Copeland owns the property and Jeff Copeland has the insurance on the property, everything's good. But if I essentially sell the property or transfer title of the property to Acme LLC, well, Acme LLC doesn't have the insurance on the property. Jeff Copeland does. And if I do a claim and I say, hey, my house burned down, please pay me to replace the house, they're going to look at it and they're going to say, you don't even own the house.
Yeah.
You have no insurable interest in this property. And so by trying to minimize their liability, sometimes they're creating a huge liability with their insurance coverage.
Yeah, that's a valid point. And I just ran into that same situation with my car. My car was in the name of the business, but my insurance was in my personal name, and I had to either get a commercial policy or I had to move the car back into my personal name, which is what I did. Because like your people that you're talking about, I thought that it might be a better option for me to put it in the name of the business. It was not.
Yeah, commercial auto insurance is very expensive.
Yeah.
One way I've gotten around this, and I don't think it'll work on houses, but you put your car in Tracie Mayo or Savvy Mortgage LLC.
Smart.
And that way either or has an insurable interest, and that's how I typically title my vehicle. So that's bonus content for auto coverage.
Good to know. Thank you.
With interest rates and everything else, we touched on this earlier. Where do you see the Tampa Bay real estate market going in the next 2 to 5 years?
I see it only going up, honestly, leveling out, maybe plateauing a little bit as the rates start kind of creeping up. But the values, I mean, they just continue to go up there. I'm amazed at the property values around, but they're definitely not going to go down. I don't see them going down. What are your thoughts?
I ask people that question all the time, and everyone pretty much echoes your thoughts. That it's a supply and demand thing at this point. But there's also what's driving demand. I had an interesting meeting this morning with the director of the Tampa or the St Petersburg Innovation District, and they're sort of like an economic engine type that brings in these industries like ARC Industries and some other big defense contractors and maritime industry contractors into downtown St Petersburg, down by the waterfront and the airport, and their anchor institutions are USF, the University of South Florida, the hospitals downtown. And so they've got these big anchors, and they've got these other innovative companies that are coming into this district. And it was really interesting talking about how that ties in and sort of parallels the real estate market. These companies move down here, they hire more people, they bring in more people, and it creates demand for housing. And it's a real problem for some of these companies because their people can't find any place to live. And in some cases, they're driving across the bridge and living somewhere else because we don't have anything here available for them.
Yeah. Yeah, and nobody wants to drive across the bridge.
That is true. It's like it's a mental block.
It is
like
a
if
mental
you drive
block.
across the Skyway, it's like you need your passport or something. So what is a tip or a trick or a word of wisdom that you would give to a real estate investor sitting in the Midwest or the Northeast? They're thinking about getting started and buying their first investment property in Florida. What are some good things that they can do to help them get started, especially from a financing lens?
Yeah, from a financing standpoint, I'm going to say talk to a lender sooner rather than later, because you really need to know your numbers. You really need to make sure those numbers are going to work. You need to make sure you're going to qualify for what you're trying to do. And I would also tell you that once you get your credit pulled, don't be too afraid of maybe shopping it around yourself a little bit if you need to. But as long as you've got your credit being pulled within a certain time frame among various mortgage lenders, it should not really hurt your score. But I would also recommend, and this is going to be a plug for brokers here, mortgage brokers, you're gonna want to work with a mortgage broker and not a lender like a bank, because the broker is going to have different options for you, and they're going to basically shop it around for you. So you really don't have to go to different lenders to see what they've got. You've got a broker that has options. And that would probably be my biggest recommendation.
Yeah, that's a great insight. I think if you go to a local bank or even a regional or national bank, it's kind of like the old Ford Model A. You can have any color you want as long as it's black.
Yeah.
And so you can have any mortgage product you want as long as it's this one right here. That's the only one we offer.
We've got.
Take it or leave it.
Yeah.
If you go to a mortgage broker, it's like, well, we can't get you into that loan, but we can look at this other lender. They offer this product, or you might have product A, product B, product C, different rates, different terms, different down payments, and you pick the one that works best for you. And I know we've done that exact same thing. For my own properties. So I also wanted to go back. You brought up another good point about credit pulls, and that kind of branches into two directions for me. The first one is there's a lot of people that are so sensitive. I don't want to have my credit pulled. I don't want to have my credit pulled. And it's good to be wary about your credit score, obviously, especially if you're a real estate investor. But it's my understanding that a credit pull is like maybe 2 points, 3 points on your credit report. It's not going to drop you 20, 30 points and like move you into a different category of credit score. If you're at a 650, it might drop you to a 647.
Exactly.
And then like you said, if you go out and you shop around with 5 different mortgage lenders for the same product, it really shouldn't drop you any more than the initial pull, the 3 points. So if you're wary about having your credit pull, it's not as scary as you may have been told. It's a single digit temporary drop in your credit score, and it's not going to break the bank.
Agreed.
The other area where that ties into, and we didn't talk about this, is the pre-approval letter. And as real estate brokers, real estate agents, a buyer comes to us and says, hey, I want you to show me 5 houses this weekend. Usually our first question is, where's your pre-approval letter? Which lender are you working with? And sometimes they'll push back and say, I don't want to do that because I don't want to have my credit pulled. But I want to go shop for houses. And it's sort of an educational process we go through with buyers, because it's like, well, first of all, you got to sit down with your lender, and we have to really know for sure how much you're qualified for. Because if your lender says we can do 250, maybe 260, I'm not going to spend the weekend showing you $350,000 houses.
Exactly.
We need to understand what your limitations are. And the other part of it is, if we go out and we find the perfect property, you love it, it's going to go under contract tonight, we just know it, and we've got to get an offer in, nobody's going to take your offer seriously if it's not accompanied by a pre-approval letter that shows you've gone through the hoops, you've worked with a lender, and we know for certain that you're qualified for this loan. If you just submit an offer with no financing or proof of funds, if you have the cash, nobody's going to look at it twice. And so you have to have a pre-approval letter in order to legitimately start shopping and making offers on properties. So
agreed.
I said all that to ask you, like, what's the process for getting a pre-approval letter? Some places offer a pre-qual versus a pre-approval. And what's the difference for somebody who's trying to get started with a lender and get the ball rolling with their real estate agent?
So a pre-qual basically means that we've talked, I may have run your credit, we've talked about it, I've given you an idea of what you qualify for, and then I'll give you a pre-qualification letter. A pre-approval, and that's what we do, we generally get all of the documentation needed up front. There may be 1 or 2 documents that we don't have, but for the most part, we have enough to make a credit decision as far as making sure that we feel comfortable giving you the pre-approval. But we also run you through desktop underwriting, which is an automated underwriting system that the underwriters actually use when it gets in front of the actual underwriter. So as long as we can get an approved eligible in the automated underwriting findings, then we know you're good to go. We give you the pre-approval letter and you're golden. And then we basically just wait on you to go under contract, and then we submit the file over to processing, and then it starts going through all the mortgage magic in the background.
Yeah, that's a great point. I love the fact that the desktop underwriter, like, you use the same tool that the mortgage underwriter is going to use on the back end. So if you've already done it and it says you're good for 275 or 500 or whatever it is, you have a really high degree of confidence that it's going to be good when it gets to underwriting.
Yeah.
Speaking of limits, 500, 600, is there still a jumbo? At what point do you get out of conventional and get into jumbo? And I know that number changes every few years, but what are the limits right now for conforming loans?
Yeah, so the conforming loan limit right now is $647,250. So, and that's for a single family. Now, if you start going into multi-unit, anything above that is considered jumbo. But if you start going into multifamily properties, it actually goes up. It increases. It's the same thing with the FHA. You've got a loan limit there. And as long as we can stay under those loan limits, then you're fine. You're not at a jumbo.
And what is a jumbo loan for people who may not know? What's the difference?
So the difference is the rate. Number one is probably the biggest thing that people will see the biggest difference in is the interest rates. Interest rates do tend to be a little bit higher with jumbo. The down payment requirement is higher for jumbo, and it basically just has different underwriting guidelines. So where I might be able to take a client up to, for example, 50% of their income in monthly obligations, jumbo's never going to allow that. It's going to top out at like 43. So, and they do have credit score differences that they require. Normally, they need a 700 to 720 minimum score. So that's where the jumbo differs from conventional.
Yeah, that's a great point. And another just thing to point out, the 647,250, that is the loan amount. So if you're doing 75% LTV, you can actually do a higher purchase price, but 647,250 is going to be your 75% loan amount, correct?
Yeah, exactly. And that's for conventional.
Or 20%, 80% if it's a primary residence.
Yeah, exactly. And so that's the loan limit for conventional. I had to look up FHA because they do change every year, and I've forgotten what the FHA max is, but right now it's $426.80. So as long as the loan limit is $420,680 or below, then you're fine for FHA.
And what that might mean for some buyers is it's above the max loan limit, so you're going to have to put a higher down payment.
Yeah.
If the FHA would have been 3.5%, but you hit that upper loan limit, well, now you may have to put down 10%. But It can still be a really good deal compared to 25% down on conventional.
True.
And the one thing we haven't talked about much, and it doesn't apply quite as much to investor buyers, which is kind of our focus here today, but it's VA loans. Mm-hmm. If you're fortunate enough to qualify for a VA loan, that opens up a whole other world of possibilities as well.
Oh, yeah. VA is awesome because you can get in with 0% down, and you can buy multi-unit properties with VA as well. So technically, VA and conventional loan limits are pretty standard. Pretty much the same, but VA, we can go a little bit higher and still keep them at 0% down, and it might be considered a high balance VA loan, but they don't now become a jumbo conventional. So it's a really good option if you're a veteran to use that for sure.
Sure, and that's for primary residence
only.
Just to clarify, you're going to have to live in it for probably at least a year, and then you can only have at the most possible 2 VA loans. So if you buy another primary somewhere else, until you refinance out of it, you're not going to reset your VA eligibility.
Agreed.
And there's all kinds of a matrix of rules and regulations that go into FHA, VA, and even conventional to some extent. So for somebody who listens to this and they're still totally confused, how do they get in touch with you and ask their specific question? Yeah,
so you can go to my website, savvymortgage.com. That's savvy with 2 V's. You can give us a call, 727-877-5684. We are licensed in Florida, Georgia, and South Carolina. And if you don't reach me, you will reach somebody on the team. And if you need to get on a calendar with me, if you go to the website, you can actually schedule time to talk to me directly.
Yeah, that's incredibly useful because sometimes you send an email and you're not sure when they're going to get it. But if you know, hey, I'm available Tuesday afternoon, you can schedule Tuesday afternoon, get on Tracie's calendar, and ask your specific question.
Yeah.
Well, this was a relatively short episode, but I think some of that is because you've already been on. We already have over an hour of content in a previous episode where we dive into all kind of financing stuff. So if you haven't seen or heard that episode, look back through the podcast or the YouTube channel and you'll find it a few weeks back. Mm-hmm. And if you have other questions about residential mortgages, now you know where to go. Tracie, thanks so much for coming in today. It's good to see you. And thank you all for listening, and have a great weekend. Thank you for listening to the Copeland Morgan Media Real Estate Podcast. As you can imagine, producing this great educational content takes a lot of effort and commitment on our part. We only ask one thing in return. Please subscribe to our podcast using your favorite podcast app or by visiting copelandmorgan.com/podcast. And remember, there's no greater compliment than referring us to a friend or colleague. Until next time, I'm Jeff Copeland.